In this video, we're going to look at fundamental analysis for beginner traders. First of all, what is fundamental analysis? So fundamental analysis is where traders, rather than interpreting movements on the chart, will interpret fundamental factors, so anything that's going on in the wider economy. This can include any kind of economic data, news release, earnings reports, interest rates, central bank speeches, and much, much more. So we're going to head over to the ThinkMarkets economical calendar now, and I'm going to show you some of the basics of fundamental analysis for beginner traders. So the first rule of fundamental analysis when you are a beginner trader is, when in doubt, stay out. So before you understand how to interpret the news releases, you'll want to use the economical calendar as a way to see when the news releases are going to be released, and then stay out of the market at those times. So you'll want to be logging onto your ThinkMarkets economical calendar every day, checking what the news releases are, and making sure you're not in any open trades at those times. However, as you develop your skills as a trader, you'll obviously be able to start to understand how to use this information to help you make trading decisions. I'm going to give you a few of the basics in this video. So first of all, how to use this economical calendar. I'm going to use the United States and their economic data as an example. And the reason for that is because the data which comes out of the United States will have an impact on all other markets, whereas all other markets don't have an impact on the United States. If you're trading another currency, or if you're trading a Forex pair, for example, like euro dollar, you'll also want to tick euro, and then you'll see that the European news also comes out. Over here on the filters, you can select whether you want to see low, medium, or high, or all three. I tend to just tick high, otherwise a lot of news data comes out that doesn't necessarily have a big impact on the market. I also quite like to tick holidays, and the reason for this is I don't necessarily understand all of the United States holidays, as I don't live there. So ticking holidays helps me to see if there's any holidays that I wasn't aware of which would still impact the market. Over here you'll see three columns. These three columns are really important. This column on the right is the previous. This means the last time this piece of data was released, this was the result that came out. This column here is the consensus. So this is what's expected to come out this time. And then this column here is the actual. When the news comes out, you'll see this column will get filled in. These are really important because often the consensus has already been priced in to the market by the time the actual is released. So when news data comes out, you're not actually going to be reacting to all of it as a trader. You want to use your fundamental analysis skills to know when it is a good opportunity and when it's not. And one thing that's quite helpful is seeing if the actual is really far away from the consensus. As the consensus has already been priced in, often when the actual comes out close to or the same, you don't tend to get as good a trading opportunity. However, if the number is much higher or much lower, you can sometimes get a much better trading opportunity. It also becomes really difficult if the actual comes out and it's between these two numbers. That means that perhaps it was higher than before, but not as high as expected, which can be a confusing grey area to try and trade in. Another little tip for using the economical calendar is to be aware of what people care about at the moment, because each piece of data has its little moment when it's going to have a higher impact. For example, during the pandemic, inflation was a huge issue. So when CPI data was released, it used to have an enormous impact on the market. But as people became less concerned about inflation, it stopped having such a high impact. And finally, another thing to be aware of is that often the stock market and the currency will move in opposite directions. This is because of the way that people invest. When interest rates are high, people tend to put their money into the currency, and that's because they want to make the most of the guaranteed high interest. When interest rates are low, they might take their money out of the currency and put it into the stock market. And this is to try and make the most of the potential higher returns of the stock market. So you'll often see them moving in opposite directions. So you want to be aware of when something is good for the currency, it will often have an opposite effect on the stock market and vice versa. So now you know the basics of fundamental analysis. If you haven't yet watched the previous video on ThinkMarkets, it's on technical analysis. I would recommend going to watch that now. Technical analysis is where traders interpret the movements on the chart rather than the news releases and the economic data. There's a bit of a misconception in trading that you should pick one or the other, but actually they work really nicely together. In the next video, I'm going to be talking about trading psychology for beginner traders. So if you don't want to miss that video, make sure you hit subscribe to ThinkMarkets now. And if you hit the bell button as well, you'll be notified when all future videos are released and you won't miss any.